An important theme going into 2023 is luxury retailers and luxury brands. And I'm starting to look more and more into these companies. And a good one to start with is Canada Goose. And that's what I'm going to be covering in this video today, guys. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? And it has not been a good year for Canada Goose. You can see that they are down approximately 64% from their peak in November of 2021, or that could even be December of 2021. So what exactly has happened? Well, ultimately, it just comes down to people are expecting the consumer to slow down. And the one thing that they cannot purchase this year or next year as rates go higher and higher are luxury goods like outdoor winter jackets. You're just gonna have to make do with what you have in the closet already. At least that's what investors are thinking. Now, if you're not familiar with Canada Goose, you can see over my shoulders or here and here that those are the types of products that they make. And in fact, these jackets are so warm that they become a staple in Canada. And in fact, I might be the only person in all of Canada who doesn't have a jacket from Canada Goose. I just throw everything into the stock market. And so I'm still wearing that old stuff from Walmart, which is perfect for me. But enough about me. What is Canada Goose doing? Well, this is a company that has roots in Canada and they have a substantial amount of sales in Canada. And so one of the things that they have to do as they become a global brand is start retailing globally. So what exactly is their strategy here? Well, notice that they've targeted that question in their latest investor presentation, and they believe that there's a massive amount of global growth ahead for the company. They believe that the Asia Pacific region is their largest addressable market, and they're going to go after them. They're also going to try to increase sales in the US and in Europe. And you can see that their global strategy is working. Canada is very overrepresented, but it's also growing the slowest. Notice that it grew less than 1% in 2022, their fiscal year 2022, because they're in fiscal year 2023 right now. In the US, they grew 34% year over year. In the EMEA, they grew 26% year over year. Those are still developing markets. And in the Asia Pacific region, they grew 25% year over year. So they are making strides globally and it's working. But the question is, I want to know more of what they're doing in their largest addressable market. Just saying that you want to grow in the Asia Pacific region is not enough, because there's a lot of luxury brands that are just not successful in the Asia Pacific region. Well, they actually answer that question. You can see that in Japan, they actually went after growth by announcing a joint venture with a former distributor. And what this allows them to do is sell products without making any upfront capital cost commitments. And so that's really good for them to grow in the developed economy of Japan. In South Korea, they actually signed a distribution agreement with a company to accelerate growth in that market, and they have a longer term path to a direct-to-consumer model. But one question that has been hitting a lot of retailers recently is, how are you dealing with the supply chain challenges and inventory buildup in this current environment? It's not exactly been a great time to invest in retailers. Well, they answered that question as well. They do believe that they have a resilient business model where 84% of their units are made or purchased in Canada and 14% are made or purchased in Europe, at least in calendar year 2021. And so while many of their peers are guiding to lower gross margins in fiscal year 2023 due to supply chain disruptions and expedited freight costs, their model is actually helping them insulate their gross margins. And notice that their gross margins in the first quarter of fiscal year 2023 actually increased from 54.5% to 61.1%. But the one thing that I do want to point out to you guys is that although their gross profit margins have increased because of their good economic model, they have not been insulated from current economic realities. SG&A as a percentage of revenues has increased, which is pushed their loss in the quarter higher than where it was last year. Albeit it was only a slight increase, but it's important to point out because it's something that we got to pay attention to as the year continues for them. And as it relates to inventories, unlike most other retailers, Q1 of their fiscal year 2023, inventory as a percentage of the annual expected revenue has actually declined from approximately 50% last year to approximately 40% this year. So they're actually running leaner this year than they were last year. So that's really good, but something to pay attention to. Inventory is always something to pay attention to for retailers. And so the question is, where exactly do they expect results to end in fiscal year 2023? Well, notice that they're guiding for revenue of approximately $1.3 to $1.4 billion. So that's a huge growth compared to last year. And they expect their net income per diluted share to be approximately $1.60 to $1.90 per share. So at the midpoint, that means that this company is trading at approximately 14 times earnings, or maybe closer to 13 and a half times earnings. That's very low for a retailer that has a ton of growth ahead of them. But the question is, how exactly am I modeling this opportunity out? Well, note that they did give strong guidance for fiscal year 2023 at 20% revenue growth. I just don't expect that to carry into 2024 and beyond. So there is some upside to my model here. I'm being very conservative, and even bringing that growth down to 7.5% in 2029 and beyond, I think that might be a little bit too conservative relative to where their growth has been and the trajectory that they're on. But what does this mean for the intrinsic valuation? Well, before I get into the intrinsic value, guys, remember that approximately 80% of the watch time on this channel is from people that are not subscribed. So please, if you have the opportunity, hit that red subscribe button. Now, going into my valuation, using a terminal multiple of 20 times earning, which I think is pretty reasonable, I'm valuing this company at approximately $30 per share. And compared to their current share price of approximately $18 per share, I do believe that this company is trading at approximately 65% of their intrinsic value. Now, although I was very pessimistic in my valuation, or at least my revenue growth rate for when I valued the company out, I still want a substantial margin of safety because I'm just that kind of investor. And because they're trading at $18 per share, I was wondering, what do the cash secured puts look like at $15 per share? And so you don't have to do the math because I actually did the math for you. You can see here that the January 19, 2024 cash secured puts, if you could sell those for approximately $2.50 per share, now they're not giving you a bid or ask price here, so it's hard for me to tell exactly what they're trading at right now, but you can tell when the trading day opens and you can just check what it's at. It reflects approximately 12% annualized yield. But if you can sell these for approximately $3.20 per share, which is closer to that last price, but I just don't think you'll get it right now, that would generate a 15% annualized yield. So this is something to look into and look to see if you can actually sell that for $3.20 per share. Generating a 15% annualized yield for the $15 strike price is not a bad place to be in this investment. Now, the question is, how do you get access to that model? Well, you can get access to that Canada Goose model and all the other models that the Patreons get access to at the lower tier of the Patreons, which you see right here. And if you want to join us for an epic live presentation every month where I reserve my absolute best work for, you can join us at the upper tier of the Patreon level. Now, Canada Goose is not the only retailer on this channel that I've covered. In fact, I do believe that there could potentially be a multi-bagger opportunity with Build-A-Bear, which is a specialty retailer that very few people can compete against, and I actually made a full video on that opportunity right here.